Good evening. Welcome, Compass Consulting and Financial Family, along with all of our friends and guests that are joining us. Wow, almost May already. So, we're going to spend a little bit of time talking about January through March, and then we're going to focus on the here and now. I know I've talked about this before, but the latest data makes it hard to ignore. Government hiring has been a major driver of U.S. job growth over the last 2 years. As of February 2025, U.S. government payrolls have risen to 24 million workers, a 9.1% increase from 2022. This surge has likely bolstered job numbers, expanded the federal deficit, and contributed to inflation and economic growth. However, with federal job cuts now on the table, the economy could face the opposite via higher unemployment, a shrinking deficit, and slower growth. To put this into perspective, according to Apollo, between 2016 and 2022, government jobs made up just 7.6% of new job creation, or about 1 in every 13 jobs. But since 2023, that number has jumped to 26%, which is about 1 in 4 new jobs and over 3 times the previous average. This is an enormous increase, and I believe has helped drive 3 other trends. Government hiring artificially lowers unemployment because when the government expands its workforce, it makes the job market look stronger than it might actually be. Government jobs are funded by taxpayer dollars or deficit spending, which does mean higher taxes, more debt, or monetizing the debt or printing money. Also, when the government hires people, it puts money into their hands, which they can spend on things like groceries, gas, and services. That spending does help businesses make more money, which can boost the economy and keep the cycle going. According to the New York Federal Reserve, a growing share of U.S. consumers are foregoing loan applications due to the expectations of rejection, with the discouraged borrower rate hitting a record of 8.5% among tighter credit conditions. This is the highest ever recorded. Why does it matter? The data highlights that many Americans are feeling financially squeezed. A slowing job market is keeping wage growth in check, while high borrowing costs make it tougher to cover bills and stay on top of debt payments. Delinquency rates, though still below pre-pandemic levels, are steadily climbing, hitting their highest point in nearly 5 years. As more borrowers fall behind, lenders are growing more cautious, tightening credit, and raising the bar for new loans, reinforcing that negative outlook. With how addicted the global economy has been to credit since the 1980s, it's important to monitor debt markets. And right now, according to the New York Federal Reserve's latest survey of consumer expectation, U.S. households are showing some worrying fragility in this regard. Meanwhile, rejection rates by banks are climbing across credit cards, home loans, and auto loans. 1/3 of all auto loan applications expect to be denied. That's the highest on record. Nearly half of all consumers believe credit will be even harder to get next year. More than 40% of homeowners seeking to refinance were rejected in February. That's 4 times higher than October of 2023. While mortgage rates still high, many homeowners are looking to refinance, are likely trying to tap into equity, not to lower their payments, but to cover other debt and expenses. If they can't, some may face the pressure to sell, which is going to affect homeowner prices. The share of consumers that can come up with $2,000 in case of a sudden emergency dropped to 63%. That's the lowest on record. Remember, credit fuels demand. When wages fall short, debt fills the gap, allowing people to spend beyond their means. That's why watching debt markets and lending trends matter. Thus, if borrowing tightens and households are forced to cut back or sell assets to manage debts, we risk a debt deflation spiral, or dumping assets to raise cash to pay off debt causes falling prices, which increases the real burden of debt, leading to reduced spending, lower incomes, and a worsening economic downturn. Now, in January, the Global Economic Policy Uncertainty Index jumped to 428.9, nearing COVID-19 highs, and signals heightened uncertainty in government policy and economic outlook. This index tracks uncertainty using a mix of media coverage, such as tax and regulatory changes, economic forecasts to assess how unclear or unpredictable economic policy is at any given time. The main culprit for this current cycle of uncertainty is brewing trade wars, threatening higher prices on goods from groceries to automobiles, which could strain households and businesses around the world. Now, while uncertainty fuels volatility, it does also create opportunities. Markets often overreact, leading to mispriced assets and long-term investment openings for those who are willing to take advantage of the turmoil. The recent surge in the economic policy uncertainty index got me thinking about a couple things. Markets hate uncertainty. When uncertainty spikes, pessimism and volatility often follow. This leads to panic selling. But contrarian investors know that fear-driven sell-offs can create steep discounts and undervalued assets, rewarding those who move against the herd. Uncertainty also paralyzes businesses and households. When companies get nervous, they freeze hiring, expansion halts, and investment stalls. Households do the same, saving more, which means spending less, which is always good, feeding into the weaker corporate profits, and amplifying uncertainty in a self-enforcing cycle. Put simply, uncertainty shakes things up. But here's the silver lining. It's always cyclical. Fear, uncertainty, and panic don't last forever. Eventually, markets stop overreacting and uncertainty fades, risk-taking comes back. Meanwhile, as things settle, people will begin spending again and corporations will have an idea of what comes next, so they'll start investing again and hire, therefore fueling growth. And then complacency returns, breeding the next round of volatility, and the cycle continues to repeat, almost like clockwork. So will there be more chaos ahead? Probably. But at some point, it'll all shake everyone up just enough that things reset and then things get back to normal. Stay sharp and watch for opportunities. Now, tariffs may be the big story in the news, but the U.S. labor market continued to shrug off uncertainty in March, adding more jobs than even the most optimistic forecast by any economic group surveyed by Bloomberg. A large part of the gain came from education and health services, up 77,000. Meanwhile, jobs at restaurants and bars rose 30,000. In what is probably the best news for March, this core measures of job rose 89,000, beating the 36,000 monthly average in the past year. Meanwhile, civilian employment and alternative measures of jobs that include small business startups increased 201,000. Given these job increases, why did the unemployment rate tick up to 4.2% versus the 4.1% in February? Because the labor force, people who are either working or looking for work, rose 232,000. All right, let's talk tariffs. In 1883, the government created a civil service system for federal workers designed to limit patronage and corruption. At the time, it seemed like an innocent step, not intended to grow the government. After all, except during wartime, the government had stayed small and civilian government workers had little incentive or much leverage to use it towards any particular political end. Then came FDR and the New Deal starting in 1933, which broke through limits on peacetime federal power. FDR set up permanent entitlements and regulatory agency, which were run by a sprawling administrative state. Slowly but surely, rules and penalties to enforce them expanded to the point that unelected government workers were effectively making law outside of the scope of the Constitution. Then in 1974, 50 years ago, Congress passed a law to strip the president of the power of impoundment. Prior to that, presidents dating back to Thomas Jefferson had often used the impoundment power, in which they recognized the legislative power of the purse as the right of Congress to hand the president a purse full of money, not the ability to force the president to spend every dollar in that purse. Next, in the 1980s, the Supreme Court decided that the Chevron case, that federal bureaucratic rulemakers could legally interpret for themselves how to enforce often lazily written laws passed by Congress. Put it all together, and we had all the ingredients necessary for a massive central government that voters had little ability to limit until recently. Last year, the Supreme Court decided that the Loper Bright case, stripping regulators of the ability to decide on their own whether Congress had authorized new rules. Now, people can fight back in court more easily. And now, President Trump's administration is exercising presidential power to the max to both limit government spending and reassert the president's power over the executive branch of government, including over civil service personnel. This is important because in 140 plus years since the civil service system was created, government workers have gone from largely disinterested observers or a very small government to an extremely well-funded, unionized bureaucracy that believed in the power and the righteousness of big government. Apparently, as Doge has found, this included doling out massive subsidies to their friends in the nonprofit sector. What many have forgotten is that the executive branch of the government exists because of Article 2 of the Constitution, which vests executive power in the president. Yes, some of the spending Trump is cutting has been authorized by Congress, but if the president is to have dominion over the executive branch, a dominion he can only fully exercise if he controls who works in the executive branch, can't he eliminate the positions needed to spend that money? Or can Congress or unelected judges force him to spend it by essentially commandeering executive power? Yes, we get it. If Congress passed a law last year saying money should be spent this year, then it sounds strange that a new president can just cancel that spending. But part of the reason it sounds weird is because we haven't had a president in 50 plus years willing to fully test the limits of his constitutional authority, including impoundment. We are sure some legal experts will claim that if Trump wants to cut spending, then he has to wait and negotiate with Congress on next year's spending bills. Otherwise, he's breaking the law. But there's a huge difference between a president trying to spend money not authorized by Congress and a president trying to exercise his full authority to not spend money. Takes two to tango. And it's entirely plausible the framers would have been okay without spending unless there's a law passed to do so. Plus, a willing president in the Oval Office at the time an actual expenditure is made. Put it all together, and we may be at a watershed moment that rivals the New Deal as most important since the Civil War in terms of what the U.S. government looks like over the next few generations. Now, what does that mean for us? Investors should watch carefully, and there's no telling exactly how this is going to turn out. Now, let's talk about what's actually going on in the markets now. April. This is the third time in U.S. history the S&P has fallen 10% in 2 trading days. The S&P was up 95% to 105% on average 12 months later. Black Monday 1987, financial crisis October 2008, and COVID shutdowns March 2020. The VIX, remember that's the volatility index, is sending historic signals often seen during major market crashes, creating potential buying opportunities for long-term investors. Let's break it down. The CBOE Volatility Index, aka the VIX, VIX, is a real-time index that measures the stock market's expectations for volatility over the next 30 days. Remember, the markets are forward-looking and the economy is backwards-looking. It is often referred to as the market's fear gauge. When the VIX moves higher, it signals rising fear or uncertainty in the markets. When it moves lower, it typically reflects more stable or confident market sentiment. In most cases, the VIX is inversely correlated with the S&P 500, meaning that the VIX tends to rise when the S&P 500 falls and vice versa. And while spikes in volatility can feel unsettling in the moment, history shows that extreme fear has often paved the way for attractive long-term opportunities. But let's look at the data going back to 1990 when the VIX was created. Historically, when the VIX closed above 46.98, there was a 44% chance that equities delivered a positive return of 3% over the following 90 days. But over 180 days, the chance of a positive return increased to 75% with an average return of 13.4%. Now, remember, these are all historical returns and there's no guarantees of repeating these. And over 360 days, markets posted positive returns 100% of the time with an average gain of 35.3%. Remember, once again, historical returns are not indicative of future results. Now, tariffs. Trump escalated tariff war. On April 2nd, President Trump announced sweeping tariffs, 10% on all imports and 34% on Chinese goods, marking the return of aggressive trade policy with no signs of retreat. Now, China hit back by responding with a 34% retaliatory tariff on U.S. goods, sparking fears of a full-scale global trade standoff reminiscent of the 1930s Smoot-Hawley tariffs. Markets are now pricing in slower global growth. Headlines whiplash shakes the market. Stocks briefly rallied on reports of a possible delay, only to drop again as the White House reaffirmed its stance. Markets are reacting to tariff headlines and investor sentiment is hitting record lows. Now, I want to focus on the fact that we're reacting to tariff headlines without looking at the actual fundamentals of what's actually going on in the market. So what I'm going to do is I'm going to show you some actual numbers of tariffs and historically the markets. What are tariffs? Tariffs are taxes or duties imposed on imported goods by a government. Why are they used? Their intent is to protect domestic industries, encourage local production, generate government revenue, and reduce reliance on foreign goods or respond to trade policies of other nations. What is their potential impact? Tariffs raise prices for consumers, affect trade relationships with other countries, and can influence economic growth. Here's a chart showing how tariffs have worked from 2017 to 2020. You can see here that this is back when Trump was first in office and he imposed tariffs on solar panels. Then we had steel and aluminum tariffs. The European Union imposes retaliatory tariffs. We got US and China fighting, and then Turkey imposed some tariffs. We got Trump and South Korea announced a deal to temporarily halt the escalation of tariffs. So you can see here kind of what's going on. But the average effective U.S. tariff rate has been significantly lower in the last 40 years due to a combination of multilateral and regional trade agreements, economic policy shifts towards free trade, and the expansion of global supply chains. For much of early U.S. history, this is dating back to 1790, tariffs were the government's primary revenue source. That changed with the 16th Amendment in 1913, which introduced the federal income tax, now the dominant revenue stream. The U.S. simple average tariff rate across all imported goods is as low as 3.3%. compared to its top 10 trading partners. So basically what we're trying to do here with some of the tariffs is we're just trying to even the playing field. Major economies like the European Union, China, and India maintain higher tariffs on imports. Among these key trading partners, tariff rates vary widely due to different trade policies and economic structures. In 2024, Mexico was the largest overall exporter to the U.S., but a closer look at individual states reveals a different picture. Canada emerged as the top exporter to 22 states, followed by China and Mexico, which each led in 10 states. Montana had the highest concentration of imports from a single country, with 91.8% coming from Canada. In contrast, New Jersey had the most diversified import sources, with its top trade partner, China, accounting for just 9.3% of total imports. In 2024, Canada remained the top destination for U.S. exports. So this chart is looking at exports, not imports. Serving as the largest market for 32 states, and Mexico followed at a distant second, serving the top export destination for 9 states. North Dakota had the highest export concentration to a single country. In recent years, there's been a major shift in U.S. trade patterns. With new tariffs on China, this trend is expected to continue. China was once the top exporter to the U.S., but now Mexico holds the top spot, with China falling to number 2 and Canada close behind. Canada and Mexico are the largest trade partners for the top 2 U.S. imported products, which is autos and crude oil, while China is the leading source of U.S. technology imports like computers and phones. So this kind of shows what is actually coming into the U.S. from these countries. This chart illustrates that U.S. exports are a smaller share of GDP compared to its top 5 trade partners, which relies more on exports for economic growth. There's a lot going on in the markets right now. The most important thing is look at your financial plan. Is your financial plan protecting you against volatility? If you don't have a financial plan in place, please feel free to reach out to us here at Compass Consulting and Financial. We'll help you get one in place. For those of you that already have a financial plan with Compass Consulting and Financial, we look forward to reviewing your plan at your next annual review. We also look forward to welcoming you all to our new offices that we have opened, and we're almost fully operational. We are looking forward to being fully operational on Monday, April 28th, with our first in-office appointment the first week of May. We look forward to talking with you all soon. As always, remember, don't focus on the headlines, focus on the facts. Any questions or concerns, don't hesitate to reach out to us. And as always, have a great evening.